This is Nightly Business Report with Tyler Matheson and Sue Herrera. Funded in part by...
All it takes is a spark. One idea to take flight. The courage to seek the unknown. To innovate, disrupt, to move us all forward. To explore a different perspective. At NASDAQ, we connect the world. Its ideas, its capital, its businesses, the people that drive global economies. The future isn't tomorrow, it's right now. All it takes is a spark. NASDAQ.
Surprise offer. Kraft Heinz's proposed bid for Unilever would create one of the biggest corporate acquisitions in history, but it's also raising a lot of questions.
Big order. President Trump suggests the government could buy more Boeing planes, and the stock hits a new high.
Coal country celebrates. The president follows through on his promise to roll back regulations. But is it enough to get the ailing industry back on its feet? Those stories and more tonight on Nightly Business Report for Friday, February 17th.
Good evening, everybody. Kraft Heinz is hungry for a deal, a big one worth more than $140 billion. The food conglomerate, backed by billionaire Warren Buffett and the Brazilian private equity firm 3G, made a takeover offer for Unilever in what would be one of the biggest deals ever. But Unilever said, hold the mayo, and Kraft Heinz may not take no for an answer. That may be why shares of both companies soared double digits in trading today. Sarah Eisen explains why this may just be the beginning of a consumer foods saga.
Kraft Heinz, which itself was born out of an acquisition put together by Brazilian private equity giant 3G and Warren Buffett just in 2015, is now trying to combine itself with the mega British-Dutch company Unilever. Unilever owns Dove soap, Axe deodorant, besides food brands like Hellmann's Mayo and Ben & Jerry's. And while it rejected this current proposal, Kraft says it still looks forward to reaching an agreement on the terms of a transaction.
The real key is just the willingness of Unilever as a seller. Clearly stated that they don't think there's a financial or strategic merit to the offer as it stands at the right price. There's something that looks like it might be likely to happen.
What's particularly interesting here, everyone expected Kraft Heinz and 3G to pursue a new deal in food. Unilever is both a food and household products company, about half and half. And what the common thread in both of those industries is lack of growth. Big food and household products companies have struggled to keep up with changing consumer tastes and habits, eating healthy, changing the way they buy basics. They're going now online and to their mobile phones, coupled with a slowdown in emerging markets, which accounts for about 60% of Unilever's sales. The going has been tough for these big companies. So 3G's playbook, swoop in, buy up the companies and cut costs. We're talking major slashing of costs that boost profit and often include job cuts. What happens next? Some analysts say that the price of this offer will go up. Kraft has until March 17th to announce a firm intention to make a specific offer or walk away under British law. 3G is pretty quiet about its strategies.
Maybe all they want is the food. The speculation, which I think makes sense, is they probably don't want Dove soap and all the personal care products.
Either way, investors are certainly excited about the prospect. For Nightly Business Report, I'm Sarah Eisen.
And as Sarah just explained, 3G is known for its hard-driving management and deep cost cuts. So what happens when the Brazilian private equity firm swoops in? What happens to workers and jobs? Fortune magazine wrote about exactly that, and you just saw Jeff Colvin. Well, he rejoins us. He is the writer of that article, senior editor at large, and he joins us tonight from Fortune. Good to see you, Jeff. Welcome back.
Hi, Sue. Thank you.
You know, you said you anticipated that they would be making an acquisition that was large, but this one even surprised you.
That's exactly right. This was totally predictable because it was clear they had to make another acquisition. That's how 3G companies grow. They don't grow organically, they grow by acquisition. So they had to make a buy. What was astounding was that no one on Wall Street, nor I, imagined they would ever go after a target as big as Unilever.
Do they really want, I think you sort of referenced this, do they really want everything that comes with Unilever, from Axe deodorant to soaps and other things, or do they just want the food brands?
Well, first of all, they never announce stuff like this, and they don't talk much to the press. But I find it hard to believe that they really would want anything other than the food. The whole history of 3G is food and beverage. Beer, Burger King, Tim Hortons, Kraft, Heinz, it's all food and beverage. I don't see them leaving that.
You know, Jeff, the political climate, though, for job cuts and things like that is not favorable for 3G. Now, granted, it is a Brazilian private equity firm, but what about the way they might have to do this? Because their MO is to kind of come in, close plants, slash jobs, cut costs.
That's exactly right, and I'm sure that that's the playbook they would be following this time. It was going to be a real problem because they've done it in the United States and mostly without trouble. The environment in Europe is very different. Worker protections are far greater. Unions are far stronger. They could have a problem trying to run their playbook in Europe.
So Kraft Heinz is 3G on the one hand. It is also Warren Buffett on the other, right?
Oh, yes. In fact, he owns more of Kraft Heinz than 3G does.
How active a driver do you think he would be in this kind of acquisition? And as you point out, they have to do this because they're not growing otherwise.
That's exactly right. Buffett is an important source of financing, but he has made clear that he doesn't want to run these companies, and in fact, he has said that 3G runs them far better than he ever would. So I think his role will probably be in the background as a financier.
Do you think that they can pull this off, Jeff? I mean, they did it certainly with beer, but the food business, as Sarah pointed out in her piece, is very different, and consumer tastes are changing fairly rapidly as well.
Well, they are. I mean, the first question is, will they actually be able to do the deal? It seems no one has ever stopped them from getting what they wanted in the past, so they are formidable. How they can manage in the food business as tastes are changing, well, that's what they're trying to adapt to.
All right, Jeff, thanks so much for spending time with us.
You bet.
Jeff Colvin with Fortune Magazine.
Well, SoftBank is reportedly making a new attempt to merge Sprint and T-Mobile. According to a Reuters report, Sprint's majority owner, SoftBank, plans to approach T-Mobile's majority owner, Deutsche Telekom, about a get-together. Now, SoftBank has to wait until the end of the FCC spectrum auction in April. The Japanese multinational company first tried to merge Sprint and T-Mobile back in 2014, but abandoned the pursuit on regulatory concerns. The report sent shares of both T-Mobile and Sprint higher, as you see there.
On Wall Street, the Dow inched higher just minutes before the bell to extend its win streak to 7 straight record closes. The upbeat merger news and a climb in Boeing shares ultimately helped offset a decline in the energy sector, and we'll have more on that in just a moment. The Dow Jones Industrial Average added 4 points to 20,624. The Nasdaq was up 23, and the S&P 500 rose 3. For the week, the 3 major indexes all recorded gains that exceeded 1%.
Boeing was one of the top-performing Dow stocks today. This after the president praised the company at its South Carolina plant and suggested that the government could buy more planes from the corporation. It is the same plant where just days ago, workers rejected joining the machinists union. Phil LeBeau has the story from Charleston, South Carolina.
Here in North Charleston, South Carolina, President Trump spent more than an hour touring the Boeing plant, introducing the new Dreamliner, the 787-10, and talking in front of about 6,000 Boeing workers about their future, about manufacturing in America, and about his pledge to bring even more jobs into this country.
We want products made by our workers in our factories, stamped with those 4 magnificent words: made in the USA.
The 6,000 Boeing workers who were here listening to President Trump gave him several rousing applauses as he was talking about the importance of manufacturing in America. And when he ended his speech, he said, "God bless the United States of America and God bless Boeing." Music to the ears of these workers.
It was a really neat experience being able to hear what he thinks about the aircraft. It's been a long time coming, and it's just been incredible.
I think it represents what South Carolina is looking for, especially with the union vote that didn't go through. We're working for South Carolina and for Boeing, and we're here to stay.
I love the fact that he's looking out for America.
For Boeing CEO Dennis Muhlenberg, this is the 3rd time that he has met with Donald Trump, once at Trump Tower in New York, once at Mar-a-Lago in Florida and today here in South Carolina as Boeing rolled out its newest Dreamliner, the 787-10. Phil LeBeau, Nightly Business Report, North Charleston, South Carolina.
As we mentioned a bit earlier, energy shares weighed on the market today. It tends to be a sector that stocks follow pretty closely. And as Bob Pisani reports, it's not clear if the bulls are in control right now or the bears.
The markets may be at new highs, but one sector is showing signs of stress, and that's big oil. The broad market's been drifting higher since the beginning of the year, but oil stocks has been drifting lower. It's not a one-day affair, it's a trend. The evidence is everywhere. Chevron's at a new low for the year. ExxonMobil's down nearly 10%. The oil and gas exploration and production ETF, which is weighted towards U.S. producers, down 5% for the year. What's happening? A reasonable conclusion is that there's a valuation problem for energy stocks. The markets are still discounting a significantly higher price for oil, and a lot of people doubt that that's happening. How much higher? I don't know, but a lot of people at the end of last year were talking about oil in the 60s or even $70 in 2017. The oil bulls insist demand's improving. They say OPEC's agreement to cut production is holding, and all that's true. But look at the supply side. Traders have noted that more than 200 additional drilling rings have been added this year. U.S. production is back up to 9 million barrels a day. And oil, you know, it's $53. It's exactly where it was 2 years ago. That's right, oil was $53 on this day 2 years ago. It touched $60 briefly in June of 2015, hasn't come close since. What needs to happen? Well, in the short run, we certainly need to see inventory levels come down, and that doesn't look like it's going to happen either anytime soon. You can see why the energy bulls are having a tougher time of it recently. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Still ahead, Kraft may want to buy Unilever, but there's another consumer products company our market monitor says investors may want to consider. Wells Fargo says its retail operations were, quote, relatively stable in January. The bank has been reporting monthly customer activity in its branch banking unit ever since its fake accounts scandal was unearthed last fall. 30% fewer checking accounts were opened in January as compared with a year ago, but the number was up from December.
AT&T has expanded its unlimited data plan offerings. Earlier in the week, Verizon did the same. Analysts say the move to unlimited plans reflect an intensifying price war within the wireless industry that could put pressure on companies to cut costs.
The government-backed mortgage companies Fannie Mae and Freddie Mac are paying $10 billion in dividends to you and me, to the Treasury. Both companies earned billions of dollars of profit in the fourth quarter. Now, new Treasury Secretary Steve Mnuchin said at his confirmation hearing that Fannie and Freddie should not be left under government control without a fix. But he also said he does not want to limit housing finance.
The Consumer Financial Protection Bureau was established in the aftermath of the financial crisis. And pretty much ever since, the banking industry has been pushing for changes at the watchdog agency. But not everybody agrees on how that should be altered. Yilan Mui has the story for us from Washington. Yilan, good to see you. So
Hi, Sue.
What does the CFBP actually do, and why do the banks want to change it?
The CFPB is America's consumer watchdog agency. It's an independent agency that was established during the financial crisis. And most importantly, it's run by a single director, and the president has limited power to remove that director. Of course, banks don't like that. They've been arguing for a long time that the CFPB should be run by a 5-member bipartisan commission. They say that'll provide them more stability so that the rules and regulations that are coming out of the CFPB don't change according to the whims of whoever might be the director of the agency. So they are looking for big changes to the structure of the CFPB.
How about lawmakers? What kind of changes to that structure are they proposing? What would the GOP like to see happen?
Well, one bill that we've heard about from Representative Jeb Hensarling, who is chairman of the House Financial Services Committee, would make the CFPB's single director removable at will by the president. Essentially, the president would have the ability to fire this person whenever the president decided was appropriate. Other legislation out there that we've seen, Senator David Perdue has a rule out there that would allow the CFPB to be funded through Congress. Right now, the CFPB is funded through the Federal Reserve, so the Congress would have control of the purse strings, and Senator Ted Cruz has a bill that would eliminate the CFPB altogether, just do away with the agency.
Yeah, that was what I was going to ask. Is it possible that that might happen? Does Mr. Cruz's proposal have legs?
Well, it would take legislative action for the CFPB to be entirely eliminated. And you better believe that Democrats are not going to let that happen without a fight. This was a signature piece of President Obama's financial reform changes that he made after the recession. And this is also the brainchild of Senator Elizabeth Warren of Massachusetts. So she is not going to let this agency be killed quietly.
All right. Thanks, Elon. Have a great weekend.
You too.
Elon Mui in Washington. And to read more about America's consumer watchdog, you can head to our website, nbr.com.
Well, General Mills slashes its full-year guidance, and that is where we begin tonight's market focus. The food giant said weak demand for yogurt and soup products in the U.S. would cause sales for the year to come at the lower end of the company's previous guidance. The maker of Honey Nut Cheerios and Betty Crocker cake mixes also reduced its profit expectations. Shares were off more than 3% to $59.23. Sticking with food, Campbell's Soup saw profit and sales fall more than expected as higher promotional spending and weakness in the company's fresh food business hurt results. The world's largest soup company did reaffirm its outlook for the year, though. That wasn't enough. Shares fell 6.5% to $58.48. More food to talk about. J.M. Smucker said weak demand for its Folgers coffee and pet food products hurt results in the latest quarter. The maker of Jif peanut butter missed revenue expectations, while its lower profit was in line with expectations. Shares down 1% to $135.95.
Well, despite facing soft market conditions, farming equipment maker Deere said it saw sales improve in the latest quarter. The company also reported better than expected earnings and said it's beginning to see signs of stabilization in key agricultural markets. The company also raised its outlook for 2017, so shares were up 1% to $110.27. The Justice Department has joined a whistleblower lawsuit from 2011 that alleges that the health insurer United Health Group overbilled the government's Medicare program by hundreds of millions of dollars, maybe even billions of dollars. United Health Group said it rejects the claims and plans to contest them vigorously. Shares were off more than 3.5% to $157.62. And health insurance insurer Aetna said it is doubling its quarterly dividend to 50 cents per share. The annual yield is now more than 1.5%. The company also said it would add $4 billion to its existing share buyback program. Aetna shares were down 3% to $125.27.
And now to our market monitor, who has names of stocks she says could grow 15% over the next year or so and also provide some nice dividend income. And get this, the last time she was on in July, she recommended the following stocks, and they have all risen double digits, some by as much as 58%. Marianne Montaigne, portfolio manager at Gradient Investments. Marianne, welcome. Let's say we do it again, just like last time, all right?
You know, I'm a tough act to follow, Tyler.
You are a tough act. Well, follow yourself here. Let's start with British American Tobacco. Why do you like it?
Right. So this is a company that is acquiring Reynolds American, and they can leverage off of Reynolds' portfolio around the world with products like Newport and the Vapor e-cigarettes. It yields 3.5%. It's valued far lower than any other consumer staple stock, and particularly the other tobaccos.
Next on the list, Invesco. You say it's not like some of the other banks that are out there. Why?
Yeah, when you look at the financial sectors, the banks have done extremely well since the election. And here's a financials name that's not a bank. It's an asset manager. And perhaps you know the exchange-traded funds that they offer, Power Shares. Mm-hmm. So with the gains in the stock market, they gain assets under management, and their fees grow. And along with the explosion in exchange-traded funds, we expect them to continue to do very well. Again, a nice dividend yield, about 3.2%, and a multiple of 12, where the market is more like 17 times.
You know, the food business, Marianne, much in the news today with that proposed merger of Kraft and Unilever. Your third pick, probably benefiting one way or another from these discussions, is Nestle. Why do you like it?
Well, Nestle offers a 3.5% yield. So again, we're looking toward 15% total return from these three names over the next year or so. So that's a nice start with 3.5% yield. But their focus has been on wellness, and for the first time in about 100 years, they've actually gone outside their own ranks to bring in a new CEO who happens to be from the healthcare side of things. So we expect a change in the portfolio toward faster growing wellness type products. And those happen to be higher margin products. At the same time, they've embarked on a nice, substantial 3-year cost reduction program. So I think, you know, being where they are global, around the world, in Europe already, I think they stand a better chance at cutting costs than Unilever might when they encounter, or when 3G encounters the European commissions and they try to take out the headcount. I think they're up for a big battle in Europe.
Very quickly, do you like the U.S. market, or it seems as though you're favoring the international market maybe a little bit more?
Yeah, the international market has underperformed the U.S. stock market on a 1-year, 3-year, 5-year, and 10-year basis. So we think valuations are better overseas than they are in the U.S. We think the U.S. is fairly valued, not fully valued, still upside in the U.S., but more upside overseas.
All right, Marianne, thank you again for being with us, and congratulations on your very good picks last time. May you do it again. Marianne Montaigne with Gradient Investments.
Coming up, did coal country just get a shot in the arm?
I'm Contessa Brewer in Powhatan Point, Ohio. This is coal country, and coal country gives President Trump a big thumbs up for taking a first big step toward fulfilling his campaign promise. That's ahead on Nightly Business Report.
Here's a look at what to watch next week. On Tuesday, Dow Components, Home Depot, and Walmart report their earnings. Macy's does as well, and it has seen 7 straight quarters of falling sales. Wednesday, the Federal Reserve releases the minutes of its latest meeting. Investors will be looking for any hints on the timing of the next rate hike. And on Friday, we'll find out how many new homes were sold in January, and that's what to watch next week.
The Senate today confirmed the president's pick to head the Environmental Protection Agency. The votes for Scott Pruitt were mostly down party lines. He is expected to waste little time when it comes to scaling back high-profile environmental regulations. Pruitt was one of about 24 mostly Republican state attorneys general who sued the Obama administration over many of its environment rules.
Coal country cheering today as President Trump takes a step toward fulfilling a major campaign promise to bring back a declining industry. As we told you yesterday, the president signed a law that removes an environmental rule that coal miners saw as too broad, too burdensome, and illogical. Contessa Brewer reports from Powhatan Point, Ohio.
Along the stretch of the Ohio River, the coal comes pouring in around the clock. And yet in this county, the unemployment rate is higher than the national average, and families have been hurting with coal's decline.
This town is nothing compared to what it used to be. I mean, this used to be all stores, grocery stores, clothing stores, everything.
Retirees like Mary Ann Anderson are helping keep the Riverside restaurant afloat. Its customers used to be mainly coal miners.
The toughest part of my job is having to sit across from a grown man and watch him crying because I just, had to tell him he was laid off.
As harbor master at the Ohio Valley Transloading Company, J.B. Holliday has seen his share of layoffs. 30,000 coal jobs have disappeared in the last 5 years, and the industry was predicting many more. It claimed the stream protection rule, finalized in December, would cost 281,000 jobs in a worst-case scenario. The nonpartisan Congressional Research Service estimated it would cost 260 jobs per year, but would create roughly as many.
It's a major threat to your jobs. and we're going to get rid of that threat immediately.
President Trump signed a law overturning the government's regulation, fulfilling a campaign promise he made to bring back coal big league. Environmentalists are furious about what the new law means for habitat and groundwater. The EPA, Department of the Interior, and Army Corps of Engineers had worked for years to structure this stream protection rule to prevent mining-related pollution and environmental damage. That's not the way coal leaders saw it.
It was a deliberate attempt by the radical people in the Obama administration to eliminate underground coal mining.
Experts say regulation is not the only challenge facing coal's revival. They say automation is among the biggest job killers, and coal struggling to compete with cheap natural gas.
I don't believe there's anything wrong with, more forms of energy. Just don't destroy an industry to make room for another one. It doesn't make sense. And quite frankly, this country cannot survive without coal.
This county certainly can't, and they're looking to President Trump to chip away at a mountain of regulatory roadblocks they see barring the path to coal's future success. For Nightly Business Report, I'm Contessa Brewer in Powhatan Point, Ohio.
And that does it for Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
And I'm Tyler Matheson. Thanks from me as well. Have a great weekend, everybody. It's a long one. See you on Monday.
Nightly Business Report has been funded in part by
All it takes is a spark. One idea to take flight. The courage to seek the unknown. To innovate, disrupt, to move us all forward. To explore a different perspective. At NASDAQ, we connect the world, its ideas, its capital, its businesses, the people that drive global economies. The future isn't tomorrow, it's right now. All it takes is a spark. NASDAQ.